This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here with today's Forex report. It is Friday, March 23rd, 2007. The dollar was a little mixed early on as traders kept the currency weak ahead of the Wednesday afternoon FOMC rate decision. The economic calendar in the U.S. was very light, with much of the focus on foreign data and a build-up to the Fed. UK data was very strong overall, with better than expected readings in CPI and retail sales. This helped the pound sterling turn things around in the beginning of the week after struggling recently to keep pace with the euro and Swiss franc. The Canadian dollar had a similar story, also finding strength on the back of CPI and retail sales numbers exceeding economists' expectations. And with oil prices well above $62 a barrel today, the currency is holding on to much of those gains. U.S. housing starts and existing home sales for February were the only two numbers released aside from the Fed decision. Both numbers surprised nicely to the upside, which helped the greenback find its footing against many major currencies. As for Wednesday's rate decision, the dollar did not respond so well. While leaving rates unchanged again, the Fed took a step back in its inflation-fighting stance, dropping the phrase "additional firming may be needed" in reference to hiking rates again. Furthermore, the committee changed its description of recent economic indicators from firm to mixed, signaling growth expectations may be diminishing. These changes forced the dollar sharply lower in the broad market in the hours following the release. However, the greenback did fight back on Thursday as traders reassessed the statement, which still said that inflation is the committee's predominant concern. For such a transparent central bank, the markets sure seem confused about the mixed language for now. Of course, as the week winds down, we still expect traders will be more apt to sell dollars than buy ahead of this weekend. Now to the big picture. The technical outlook for the U.S. dollar is growing more bearish each day in the big picture. In addition, fundamentals are beginning to line up more and more with this view. With the majority of traders now focused on when rather than if the Fed will cut rates this year, we will really need to see a big turnaround in economic data moving forward. Almost every other major central bank throughout major economies is on the hawkish side of the fence and is expected to hike rates further this year. This means that U.S. inflation and/or economic growth must accelerate in coming months if the dollar is to avoid falling to new multi-year lows in many major pairs. Housing may be one of the biggest unknowns at present, with mortgage delinquencies and foreclosures reaching alarming levels in the United States. What began as a problem with subprime mortgages and high-risk borrowers has now extended to lower-risk borrowers who used creative mortgages with such features as variable rates and negative amortizations. Such loans have left once profitable real estate investors upside down. Although the Fed claims to see some tentative signs of stabilization in the housing market, many market participants are far less optimistic. Further deterioration will likely spill over into other areas of the economy, forcing the Fed to cut rates sooner than later, a scenario that will undoubtedly add significant downside pressure to the dollar throughout the remainder of 2007. Until Monday, have a wonderful weekend and take care.